Hello and welcome to this video called The Role of Equities in a Portfolio. It's the first video in a series from the topic area called Portfolio Construction and the first learning module within it, which is all about equities in portfolio management. So very brief video, pretty easy concepts, I think, or very much revision of stuff that you should know from your level 1 and level 2 studies, listing the different roles, the different functions that equity can play in a wider portfolio context. So as you can see, 1, 2, 3, and there's actually number 4 as well below, are the different roles. I've already listed them and we'll be making some points concerning this. There are several roles played by equity investments in a portfolio context. The first of them, probably the most important, is capital appreciation. That seems to be, or tends to be, the absolute main driver of long-term returns. Long-term returns on equities, obviously not necessarily short-term. Short-term, it could be things like dividends, but when you analyze the longer term, it will be capital appreciation. Equities do tend to sort of appreciate in value, obviously in a sort of broad portfolio context over time. And a very simple statement here: when do equities tend to outperform, so do better than other asset classes? And by other asset classes, we mean the traditional ones like fixed income or cash, i.e. very short-term treasury securities, for example. Well, equities tend to outperform other asset classes, typically when the economy is quite strong. So in a strong economy, equities tend to do better than, for example, debt securities, fixed income, and they tend to underperform other asset classes. Once again, think in terms of equities versus, for example, fixed income in a weak economy. Simple, right? Very simple. Nothing new here. The second role that your book lists for equities in a portfolio context is the fact that equities generate dividend income. And, I'm not really going to write anything here because you know all about dividends, dividend policies from your level 2 studies, or at least you should know, and you will not be tested on this stuff here. But the book does kind of remind you about the fact that companies have to make that decision on a regular basis whether to pay a dividend to shareholders out of the profits generated, the net income generated, or indeed use those funds for reinvestment internally into internal projects. And whether they pay a dividend or not is a function of the opportunities that are available within the business. You will not be tested on this. It's not, this is not corporate finance or corporate issuers again. Then a very important role for equities is the potential for diversification, to offer diversification benefits with other assets. And of course, this boils down to the problem, or to the issue of correlation. The fact that equities are not necessarily perfectly correlated with other assets in terms of their performance, or their returns are not necessarily perfectly positively correlated. So equities may indeed, but with the emphasis on may, provide diversification benefits in a portfolio context, benefits. But you have to be careful here about making statements that would be too strong or too categoric. First of all, we're talking about or less than perfect correlation, positive correlation against other assets. But if you look at equities themselves and the correlation between different securities, different stocks, different equities, then it's going to typically be quite high. So correlation among the sort of individual equities or equities themselves, as opposed to equities versus fixed income, for example, is typically high. And one other point that I remember making at level 1 and level 2, and your book does repeat that point quite a lot, is the fact that correlation, measures or correlations typically go up quite a lot in periods, you guessed it, of market stress. So they increase in periods of market stress, crisis, and all those diversification benefits become very small. In fact, they stop really existing. They stop being benefits when things just go in the same direction. Equities, fixed income, all the different stocks plummet down, for example. Now, there's also a point to be made about... So, just on the third point, diversification with other assets, yes, to some extent, but to be honest, you have to approach those results or those statements with quite a bit of caution, as you also need to approach with caution the statement number 4, the fact that equities, the common opinion that equities provide a hedge against inflation. This can be true, but is not necessarily always true. Once again, a bit of a reserved statement there. So the ability of stocks with their performance of equities to provide a hedge against inflation very much varies among the individual companies. And actually sometimes not just companies but entire sectors of business or industry. If you put a company over here in the middle, then of course pretty much every company faces some input costs. The costs of raw materials used, the cost of labor, the cost of energy, right? And if those go up, the question is that company going to be able to pass those increases, those hikes in the costs onto the consumers, onto the clients? And obviously, if it is able to do so, well, then the prices of its output goes, the price of its outputs goes up as well. And yes, you've got a hedge against inflation, but that is not always going to be the case, right? There are many times when companies fail to be able to pass those increases in input costs onto consumers for fear of losing market share, of losing business. So it all boils down to the ability of the company to pass the cost increases on to the final consumer, onto consumers, right? But once again, this is a discussion that I don't think you'll be asked to replicate at all in the exam. Don't worry about this. These are fairly obvious points. I just want you to make sure you're kind of okay with this argumentation. And then the book finishes off, but it's quite a big component of the relevant section, with some considerations for including equities in a client portfolio. So what should you bear in mind as let's say an analyst or an advisor? And straight away they make the statement, well, those considerations will be described in the client's or in the investor policy statement, the IPS, and we talked quite a lot about the IPS at level 2, and we'll have an opportunity to talk about it also at level 3 later on, or at least components of it, because that is the very important document that an analyst, an advisor, and a client kind of create by discussion and by the advisor analyzing the client's circumstances and putting things down. Things like, the return objective. What does the client want to achieve? The time horizon for that. Very importantly, the risk objectives of the client. And that covers two very important areas, primarily, namely the willingness of the client to take risk and the ability of the client to take risk. Then there may be liquidity considerations to take into account, liquidity requirements. Maybe the client will need to has a planned need to spend some money that they can foresee already at some point, and you'll need to make sure the portfolio is liquid enough to cover that expense. There may be legal regulatory requirements or considerations to take into account. And then also, all of this is listed in the book, but I'm not going to write it down because it seems to be just thrown in here to create a bit more text. Whereas those requirements and those considerations are discussed later on, actually, in the same book when we talk about creating portfolios for individual clients. So I'm not going to write this down. I don't think there really is a need. But one thing your book does, for some reason, focus on here is they say, well, there are also various sort of unique circumstances for various clients or unique considerations, and those will, these days, also include that client's ESG preferences. So this is a nod towards, of course, environmental, social, governance factors. Once again, you should have had exposure to this before. We won't be saying, and I won't be surprising you with this statement. And the book does list some approaches to incorporating ESG factors into a portfolio, or how you would pick ESG compliant investments, starting with the two sort of very traditional methods, namely negative and positive screening. And even if this wasn't specifically discussed before, I'm sure you can already see where we're going here with these names. Negative screening is all about excluding specific certain companies or indeed entire sectors from a client's portfolio, because those companies or those clients do not fit with those companies or sectors do not fit with the client's view of how they want their portfolio to be invested in terms of ESG. So this could be excluding oil and gas companies that make weapons, companies that tobacco companies or alcohol companies, that kind of stuff. Positive screening, on the other hand, is not about excluding, but actually looking for companies that fit certain criteria, that pass certain tests or screens. So identifying sort of positive ESG companies or sectors. It's looking at pretty much the same thing, but from two different angles. And then maybe somewhat more modern approaches, namely thematic investing and impact investing. Thematic investing is, it's investing in companies with positive exposure to certain ESG related so-called megatrends. Megatrends is a very popular name these days in investing. Examples of ESG related megatrends would be things like green energy, so renewables, for example, and companies involved in that sector, or maybe sustainable agriculture, affordable housing would be another one. I often see something, the book doesn't mention this one, but for example, the circular economy. So companies that promote reusing instead of generating waste and throwing things out. Yeah, so that's thematic investing, and then there is also a very much related trend, namely impact investing, and this is investing to achieve certain specific targeted, be it social or perhaps environmental objectives. And your book gives the example of maybe investments targeted at companies, projects that are compatible with or in line with certain development goals that are set out by the UN. But these are not just general phrases or slogans, they are specific plans to achieve a certain goal until within a certain time frame. Don't confuse this with charity, giving money to charity. These are financial investments that are supposed to generate a return, but they are at the same time simultaneously in line with certain goals that have been set out by, for example, the UN, to achieve certain goals that should be good for our planet and the people on it.